Google, Amazon, and Apple just reported earnings today, and we're going to take a look at it. Now, before we jump into it, just a quick mention. This video is sponsored by Qualtrim. It's a website that I own and have created, and it shows you all the metrics of a company on a single page. The reason I mention it is because if you sign up today, you get the entire month of February for free. So it gives you some time to try it out. So sign up for that. Now, let's go ahead and jump in. We'll start off with Alphabet. This is the first one to really release the numbers. Let's go ahead and take a look at what this company's doing. Before we even look at it, what I want to do is just take a quick look at the stock. We can refresh this here and see how it's trading. So right now it's down around 5% after hours. So investors are not liking what they see. You keep in mind it's up 20% year to date. So it's done pretty good, but it's going to be giving back a little bit of gains if it stays like this. So it's actually trading around, now down 1.5. There we go, 4.45%. So down about 5% after hours. Let's go ahead, take a look at the key numbers here. The earnings per share was a miss. So they missed on the bottom line, $1.05 versus $1.18 per share. I'm sure investors are not too happy about that. They're probably going to have estimates go down a little bit. Then we have here revenue. Top line at 76.05 billion versus 76 versus 5.3. So they missed on earnings and they missed on revenue. Not a good start to their earnings report here. Let's take a look at the breakdown of some of the other metrics here. We know that they have YouTube. YouTube advertising revenue, 8.25 billion. I believe that's a little bit of a miss as well. Google Cloud revenue, 7.43 billion. I think that's a little bit above what the street is expecting. So overall, they're missing on most things. Now, my big issue with Google has been that they have these incredible properties, right? They got Google Search and they got YouTube, but then they're very careless with the way they spend their money. They've been over hiring. This is something that I've been highlighting for some time. So what we can do here is look at their actual earnings report. This is released now. So we've seen all these numbers so far. Let's go ahead and take a look down at the segment breakdown. We have YouTube here. In 2022 versus 2021, YouTube ads declined. So we have a decline in revenue. Is that correct? The 3 quarters ending December 2022 versus 2021, YouTube ad revenue went down. Okay, so YouTube ad revenue is down, as well as search revenue is down. So both of them, Google search and YouTube ad revenue, are both down year over year for Q4. The Google network, that's down as well. It looks like revenue across the board is actually negative year over year, which again, I've highlighted this before, and this shouldn't be something too surprising. I don't believe we have the recent numbers here. Right, we don't have this last quarter, but this is what it looks like. Just explosive growth over the past year. This is 2020, and Google almost doubled their revenue. Anytime you have that, I think there's a good chance that you're going to see a little bit of a reversion to the mean. So I think that's what we're seeing here. We have the Google services business here. So Google service business actually declined as well. So we have a lot of businesses in decline year over year. YouTube ad revenue, YouTube search, YouTube services. The one thing that should not be in decline is Google Cloud. We can take a look at that. Google Cloud grew from 5.5 billion to 7.3 billion. So that's actually growing. That's growing at a steady pace. That's a good thing. Now we get to the big one here. The number of employees, they still hired. They still increased the amount of employees. And this isn't just year over year. This is actually quarter over quarter. They have 190,000 employees. I'm blocking it with my camera here. Take a look at this. Number of employees, 190,000. So they're adding on 30, 40,000 employees. When I look at the numbers, most of these employees are going to Google Cloud. But this is a problem for Google. Getting this excessive spending and excessive hiring under control, I think is going to be like a multi-year thing. I think it's a challenge. Getting this under control, something that's been out of control, it's a challenge. And we see Google doing things like laying off 50 different massage therapists and employees that aren't necessary to run the business. So I think investors are not going to be happy to see this. And I'm assuming the decline as well as the amount of growth in employees is what's causing the sell-off here. Now, I will say with Google, there's going to be a delay with a lot of this stuff. So when you fire employees, for example, You have to give them severance for like 3 or 4 months, and in some cases it goes on even longer than that. So they take a lot of charges and expenses from even their layoffs. But overall, when I look at this report, my immediate reaction is I'm not in shock. I thought a lot of the businesses of Google were cooling down. I think it's a little bit lower than my expectations, though. To miss on revenue, miss on earnings, have YouTube slow down, have Google search slow down, have the employee count grow, and basically the only highlight be that Google Cloud is growing, not a fantastically strong earnings report. And I say that as someone invested in this company. So right now, immediate reaction without much time to dive into it, I think this is a pretty weak report. I think investors are going to temper their expectations a little bit with Google. But we'll have follow-up analysis later. I'll talk more about Google in following videos. Let's go ahead and take a look at Amazon here. It's down after hours as well. So investors don't like what they're seeing here. I'm going to make my own judgments as if I didn't see this and kind of gauge it how I would say the company's doing. I will add in the context that if we filter by year to date, Amazon ran up 32% before these earnings. So it had a massive run up, as well as just today it was up 7%. So it's actually dropped down $5, and so far this year it's up $27. So just putting in context, let's go ahead and take a look at the earnings report. This part of the earnings report I think is the most important part because it shows the growth of different segments of the business. And we can look at what's going on with the actual company Amazon and all the various businesses they own. Online stores. This is their massive first-party retailer. This is the very low margin one. Amazon sells a lot of products like toothpaste and toilet paper where they make almost no money or they make no money on it, but they do that. They subsidize it so that people have a very complete shopping experience. They have every item conceivable on Amazon. So part of this is not really to make money. It's to make it so people want to use Amazon and then they can sell their other services. This was up by 2%. 2% year over year. Basically flat, right? It's a little bit under if you factor in inflation. So they're massive first-party sales businesses. Let's call it flat year over year. Physical sales. This is their more experimental, their Whole Foods, their physical stores. That's up 6% year over year. I think that's pretty good. We have right here the more important stuff, the services. Third-party seller services. This is where other people list their products on Amazon and Amazon fulfills it and they basically charge a fee for their services. This is up 24% year over year. That seems like very fast growth, 24% year over year. And FX is not hitting them as much. So it's up 20% without foreign exchange. It's up 24% with foreign exchange. We can take a look at these subscription services. Amazon has a million different subscription services. This isn't just Prime. This is also Amazon Music and their Kindle and all their different things that you can subscribe to. This is up 17% year over year. Fast growth in their services, 24% and 17%. And then we have a big one here, their advertising services. This has grown to be a massive business from Amazon, and they did $11.557 billion in revenue. That was a 23% growth rate year over year. So still very fast growth in advertising, even as other companies are slowing down, as LinkedIn slowing down, as Google slowing down, as Meta slowing down, as Snapchat's slowing down like crazy. Amazon continues to grow their advertising services because I think it's very effective. When you go to Amazon and you search backpack, you get a bunch of backpacks advertised to you. It is very direct. They know exactly what you want because you literally type it in. So I'm very excited to see this business doing well. That's part of my thesis of Amazon is that the advertising services continues to grow at a moderate pace. We have AWS here. This is a big one, and we're seeing a deceleration. This is a bit expected. It decelerated down to 20% year over year. So 20% is still fast growth, but it is a deceleration from what we've previously seen. 28%, 33%, 37%, 40%. Then we're down to 20%. What I've heard is that as we've had interest rates rise up, as we've had the economy slow and companies cut seats and cut budget, a lot of companies are now being very careful about how much they spend on technology. They're tightening their budget like crazy. So there is an expected, I think, deceleration this year. What we'll have to watch is if the trend continues. If this goes into the teens and then the low teens, that would be troublesome. I'm expecting this to be at least the high teens or the low 20s for a number of years. So if this decelerates down to the low teens, I think that would be concerning. So right now, when I look over this on a segment basis, I see everything growing at a pretty steady pace. If we look at the actual services, third-party seller services, 24%. Subscription services, 17%. That actually sped up year over year, so the growth is accelerating with that. Advertising services, very strong, 23%. AWS, a deceleration in that. That's probably the most concerning one at 20%. But that's still right in line of expectations. In fact, if we look over here and we look at what investors were expecting with AWS, they were expecting 21.4 billion and they got 21.87. So they missed by $400 million. A very minor miss on an economic slowdown. Overall, I don't see these numbers as that concerning. And then the last thing I'll mention on Amazon is that they're still seeing, even with a slowdown, they're seeing sales increase, overall top line revenue growth. The company grew revenue by 9% year over year. In North America, it was 13%, international 8%, and then AWS 20%. So growth across the board. When I look at this and I compare the different earnings reports so far, I like Amazon's a bit more than Google's. I like the fact that all the services are still growing at double digits. The AWS is slowing down a little bit. That's the most concerning part. The advertising business, I think, is doing phenomenal. And I think the top line revenue growth is great. So I personally am not, I don't see it like the market. I'm very happy about Amazon's report. I don't have anything I'm concerned about right now. Now I got to take a look at Apple's. We have Tim Cook here and we have Apple. Let's take a look at the stock. It's down again. All these companies are down 3 or 4%, 5%. Apple's another one that you look year to date and it's up 21% based off of basically nothing. No fundamental changes. It just had a nice run. Now it's giving up a little bit of those gains. So if we look at the segment breakdown, that's what I'm looking for here with Apple. We look at the earnings. They missed their earnings per share and their earnings are down 11% year over year. So pretty steep earnings decline for a company like Apple. This is probably one of the only times they've declined earnings in recent history. Revenue, 117.15 billion versus 121. A miss on revenue. So far, Google and Apple have missed on revenue. Amazon has actually beat revenue estimates. iPhone revenue, 65.78 billion versus 68.29. Mac revenue missed. iPad surpassed expectations by a large degree. Other product revenue was 13.48 billion versus 15. So other products missed. And then service revenue, which I think is by far the most important part of the Apple thesis and story. It was a beat. It was basically in line, 20.77 versus 20.67. So we can call that in line. Gross margins, very on the spot, 42.96 versus 42.95, almost exactly. When I look at this report, again, we see a minor decline in revenue. This is already baked in. Investors were expecting this. The earnings per share miss is not great. I think Apple's still doing great. The fact that their service revenue is now $20 billion, above $20 billion is just incredible. And for me, I look at Apple as a long-term play of being that company that's a consumer staple, something people just have to have. Whether or not they sell more or less products this quarter, that's not my concern. What I'm concerned about is if they still have a dominant market position, a very wide moat, and if they're still raking in money with their toll bridge of the Apple App Store, collecting those fees with every transaction and everything that goes through them. So overall, the breakdown on Apple doesn't give me any cause for concern either. Right now, I think if you look at these earnings reports, I don't think they're too bad. I'd say the one I just think the most disappointing is Google. I just think what the management is doing with the excessive hiring and stock-based comp while the company is slowing down is not great. I think they need to get that under control sooner than later. So that's all for now. I hope you enjoyed this little follow-up. I'll have more in-depth analysis on these companies in the following weeks. So make sure you subscribe to the channel, and I'll see you next time.